Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we'll be discussing key financial ratios that play an important role in increasing the value of a business. These ratios help measure different aspects of financial health, such as profitability, efficiency, and liquidity, giving us a clearer picture of how well a business is performing. Understanding these numbers can provide valuable insights for owners, investors, and managers who want to make informed decisions to boost the company's worth. As we go through each ratio, we'll explain what it means and why it matters, so you can use this knowledge to improve your business valuation. When investors value a business, they rely on evidence rather than guesses or hopes. Financial ratios take this evidence and turn it into clear signals about how profitable, efficient, liquid, or leveraged a company is, as well as how well it grows and generates cash. These ratios are more than just measures to observe. They can be actively managed to boost the company's intrinsic value, which reflects the current worth of future cash flows and its market value, or the multiples investors are willing to pay. Throughout this presentation, we'll focus on the ratios that have the biggest impact on valuation, explore practical ways to improve them, look at real-world examples, and discuss their pros and cons. The goal is straightforward. Whether you're a founder, finance leader, or investor, this will serve as a practical guide to improving multiples and increasing cash flow. Investors focus on a few key ratios because they directly influence how a company's value is determined, especially when using discounted cash flow or comparing multiples with similar businesses. The revenue growth rate shows the pace and consistency of a company's expansion, with faster, quality growth typically leading to higher valuation multiples by boosting future cash flows and shortening the time to recoup investments. Gross margin percentage reflects a company's pricing power and operational strength, signaling how well it can invest in sales and products without hurting profits. Operating margin, which measures profit conversion from revenue, indicates how scalable and efficient a business is, affecting price to earnings and enterprise value multiples. Free cash flow margin is crucial because cash flow confirms financial health and reduces funding risks, often earning premium multiples. Lastly, the Rule of 40 combines growth and profitability into a single measure, especially important for software and service companies, rewarding those that balance fast growth with strong efficiency. By focusing on these ratios, operators can make practical choices like improving product mix, negotiating costs, scaling operations wisely, and managing working capital to drive valuation upward. Return on invested capital, or ROIC, is crucial because when it's above the company's weighted average cost of capital, it shows the business is generating real value. As ROIC improves, the company's discounted cash flow value and market multiples usually increase. Practically, this means shifting resources away from projects that don't perform and focusing on ways to boost cash returns through smarter product design and pricing. Next, net revenue retention, or NRR, especially in recurring revenue models, is a key indicator of growth without acquiring new customers, an important factor for investors and acquirers. This growth often comes from strong customer relationships, cross-selling, upselling, and usage-based pricing strategies. Then, looking at customer acquisition payback and the lifetime value to customer acquisition cost ratio, shorter payback periods and higher ratios mean the company grows efficiently with less need for outside funding, which enhances valuation. Improvements here come from better conversion rates, pricing, and managing marketing spend effectively. Working capital efficiency is about converting sales into cash faster, which lessens external funding needs and increases free cash flow, lowering risk and boosting multiples. This involves speeding up invoicing, enforcing payment terms, managing inventory better, and negotiating favorable supplier payment terms. Lastly, leverage and interest coverage ratios matter because a moderate amount of debt can amplify equity returns, but too much increases risk and raises the cost of capital, which brings down valuation multiples. Balancing these ratios helps signal financial health and growth potential to investors. When it comes to making practical decisions in business, financial ratios are vital tools. Capital allocation decisions rely on ratios like ROIC, free cash flow margin, and payback period to show where investments will deliver the best returns and which areas might be better to exit. Pricing and packaging choices benefit from examining gross margin, net revenue retention, and lifetime value compared to customer acquisition cost, helping identify when value is priced too low or when user monetization isn't maximized. In go-to-market strategy, the Rule of 40 sheds light on whether the focus should be on improving efficiency to boost margins or accelerating growth to gain market share. These ratios also play a key role in board and investor communications, offering credible, straightforward narratives that demonstrate control and scalability, like highlighting growth of 24% alongside a 20% free cash flow margin, showing a strong Rule of 40% score. Finally, for mergers and acquisitions, maintaining high and stable ratios such as gross margin, net revenue retention, and ROIC makes the business more attractive to buyers and often leads to better deal terms. All these insights ensure decisions are backed by clear, comparable evidence. To improve growth and gross margin, focus on pricing by running structured tests, offering tiered options, and adding value-based extras. Push higher margin products or services and phase out low margin custom work unless it builds lasting revenue. On the cost side, work on value engineering, diversify suppliers, and standardize where possible to increase efficiency. For operating and free cash flow margins, boost sales productivity with clear targets and reduce time spent on non-sales activities using tools like demo automation. Shift marketing spend to channels that deliver higher intent customers and adjust campaigns based on performance monthly. Automate general and administrative tasks through shared services, robotic process automation, and low-code solutions to speed up processes. Improve working capital by speeding up collections, extending payables when appropriate, and managing inventory with accurate forecasting. Maintain strict capital expenditure discipline with clear hurdle rates and decisions guided by return on invested capital. When balancing growth and profitability, tighten costs if growth slows but margins are strong, or invest carefully to push growth without sacrificing payback if margins are healthy. For return on invested capital, prioritize resources on high ROIC projects, quickly cut underperformers, and reduce the weighted average cost of capital by enhancing predictability, governance, and refinancing where beneficial. This operator playbook offers clear actions to enhance each key financial ratio effectively. To improve net revenue retention and the LTV to CAC ratio, start by designing for expansion. This means landing small with a product-led approach, then enabling customers to expand usage or seats over time. Embedding telemetry helps identify when customers are ready to expand. On the customer success side, using health scoring, proactive quarterly business reviews, and in-app nudges can reduce churn. Aligning customer success manager incentives with net revenue retention also helps ensure focus. Better onboarding plays a critical role too. Reducing time to value has a strong correlation with higher retention and expansion rates. Moving to working capital, negotiate contract terms to secure milestone billing or upfront annual prepayment, automate collections, and manage inventory by classifying stock based on importance. For supply chain improvements, using vendor-managed inventory, collaborative forecasting, and a regular sales and operations planning rhythm can reduce volatility from demand swings. When it comes to leverage and coverage, keep the loan structure within an optimal leverage band by considering downside scenarios and maintaining liquidity buffers. Avoid having covenant headroom that's too tight to prevent stress. Balance debt by matching long-term assets with term debt or using revolving credit facilities for seasonal working capital needs. This combination of strategies will help strengthen these key financial ratios and support sustainable growth. Starting with 22% year-over-year growth and a 72% gross margin, this SaaS company took several steps to improve both growth and profitability. They introduced usage-based pricing along with premium add-ons, which helped increase revenue without sacrificing margin. At the same time, they moved away from low-margin custom contracts and streamlined their enterprise onboarding processes, creating more consistency and predictability. They also automated renewal processes and built an expansion playbook focused on enabling advocates within customer organizations and using in-app prompts to drive upsell. Improving cash flow was another priority, tightening day sales outstanding from 66 to 48 days by establishing a collections cadence and offering incentives for annual prepayment freed up working capital. After 12 months, these initiatives resulted in growth climbing to 34%, gross margin increasing to 75%, and free cash flow margin more than doubling to 14%. The combination of efficient growth and improved cash generation boosted investor confidence, pushing the revenue multiple from 6.5 to 8.2 in a stable market. This example clearly shows how targeted operational changes can move key financial ratios and drive higher valuation multiples. This example shows how a premium direct-to-consumer brand with £30 million in revenue improved key financial metrics by making targeted operational changes. They started with a 48% gross margin, inventory turning about 2.8 times a year, and a customer acquisition cost payback period of 13 months. By shifting their sales mix to focus more on subscription models with auto ship options, they enhanced bundle economics. They also optimized demand planning and reduced product complexity through SKU rationalization, while renegotiating contracts with 3 major suppliers to improve costs. Additionally, they introduced loyalty tiers and referral incentives, which helped lower their customer acquisition cost. After 12 months, the gross margin increased to 54%. Inventory turns rose to 4.1 times, and the CAC payback shortened to 8 months, leading to a free cash flow margin improvement of 6 percentage points. This stronger cash generation and reduced working capital needs boosted their valuation multiple from 8 to 11 times EBITDA among private buyers. This example clearly illustrates how operational levers translate into improved financial performance and greater company value. This example shows an industrial services company with £120 million in revenue that was initially destroying value, as their return on invested capital was 7%, while their cost of capital was 9, and their net debt to EBITDA ratio was quite high at 3.5 times. To turn things around, they took several steps. They cut 2 smaller, less profitable geographies, sold off a fleet that didn't align with their core business, and shifted focus to higher margin maintenance contracts. They also implemented condition-based maintenance, which helped reduce service costs and increased uptime for their clients, making the service more reliable and efficient. On the financial side, they refinanced part of their debt, spreading out maturities and adding price escalators linked to input costs to protect margin. Within 12 months, these actions delivered a notable performance improvement. The ROIC jumped to 11%, now above their weighted average cost of capital. Net debt to EBITDA dropped to 2.4 times, and EBIT margin grew by 250 basis points. As a result of these clear improvements and reduced risk, the company's valuation multiple increased from 7 times to 9 times EBIT, reflecting the market's recognition of the value created through these focused operational and financial changes. Managing to ratios has clear benefits. For one, it brings objectivity and comparability by turning your strategic goals into numbers that investors easily understand. It also acts as an early warning system, for example. If key metrics like days sales outstanding or net revenue retention start to worsen, it signals problems before you even see earnings misses. Capital discipline is another advantage. By focusing on return on invested capital and free cash flow constraints, you make smarter investment decisions and exit losing bets faster. Plus, strong and sustained performance on key ratios like the Rule of 40 or ROIC above your cost of capital tends to improve your company's valuation over time. But there are downsides as well. When you focus too much on hitting specific ratio targets, you risk unintended consequences, like cutting R&D to boost margins, which can undermine long-term growth. Accounting factors such as changes in revenue mix, seasonality, or one-time events can also distort these metrics from quarter to quarter. Relying too heavily on peer benchmarks can be risky because it might lead you to ignore what makes your business model and customer base unique. Lastly, some ratios only improve after operational changes have had time to take effect, so you need patience and should use leading indicators alongside them. Balancing these advantages and disadvantages is key to using ratios effectively as a management tool. To keep key performance metrics visible and actionable each month, a simple, focused dashboard is essential. For growth, we look at year-over-year revenue growth, aiming for targets that fit the business stage, like 25 to 40% for scale-ups. Profitability is tracked through gross margin, operating margin percentages, with a clear view of quarterly trends. Cash health is measured by free cash flow margin and the cash conversion cycle, with a typical goal of maintaining free cash flow above 10% at scale and steadily reducing the cash cycle. Efficiency comes down to the rule of 40, which should be at least 40% and can be higher for premium software companies. Retention focuses on net and gross revenue retention, with SaaS companies aiming for net retention above 115% and gross retention over 90%. For go-to-market efficiency, we want the customer acquisition cost payback period to be no longer than 12 months, with best-in-class performance between 6 and 9 months. Capital effectiveness is gauged by return on invested capital versus the weighted average cost of capital, targeting a return at least 300 basis points above WACC. Lastly, risk is managed by keeping net debt to EBITDA within the board-approved limits and maintaining interest coverage above 4 times. This compact view helps keep priorities in sight and supports faster, more informed decision-making. When presenting ratios to increase valuation, it's important to show the underlying drivers clearly, like a gross margin improvement of 220 basis points quarter over quarter, thanks to supplier rebids and a favorable product mix, with a plan in place to maintain margins above 70%. Separate core business trends from one-off items to focus attention on sustainable underlying performance. Connect these ratios to leading indicators such as bookings, pipeline quality, and cohort retention, which help predict where the ratios are headed next. Be transparent about your targets by committing to achievable goals, ideally with a range to show confidence and flexibility, such as aiming for a rule of 40 score between 50 and 55 in the next 12 months. Finally, demonstrate the repeatability of these improvements by highlighting playbooks, process changes, and system upgrades that show these results aren't just a one-time occurrence, but are built to last over the medium term. It's important not to chase growth without paying attention to your customer acquisition cost, especially when the payback period gets too long. When that happens, it's better to cap acquisition spending and focus instead on retaining existing customers or expanding within your current base. Cost-cutting efforts shouldn't come at the expense of product momentum or the customer experience. Balancing efficiency with maintaining a strong product flow is key. Many companies also miss opportunities by underpricing, so running structured pricing reviews at least once a year can help capture more value. On the working capital side, discipline in accounts receivable and managing inventory well are often the quickest ways to boost free cash flow, yet they frequently get overlooked. Lastly, be cautious about overstating your return on invested capital by excluding essential expenses like capitalized software or maintenance spending, as these are necessary investments to sustain the business. Financial ratios are essential because they provide a common language for valuation, but their true value lies in how you use them to manage your business. By focusing on 4 key areas: quality growth, margin expansion through disciplined unit economics, cash conversion, and maintaining a high return on invested capital, you can increase both your intrinsic value and the multiple that investors are willing to pay. Start with a clear and concise dashboard that tracks important metrics like growth, margins, free cash flow, the rule of 40, ROIs, net revenue retention, payback period, working capital, and leverage. Set clear 12-month targets for these ratios and run a monthly operating review to connect specific actions with changes in these numbers. Over time, consistent small improvements will compound, showing not just in the ratios, but also in your company's valuation. This approach turns financial ratios from just numbers into powerful tools for driving sustainable business success. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.